two, three.
So what income are you taxed on really depends on how that income is generated. There's two broad types of income. It's earned income and unearned income. So earned income is what you work for. These are going to be your wages, your W-2, your tips. If you're a contract employee, it'd be 1099. Unearned consists of both passive income and portfolio income. So passive income would be, for example, real estate, maybe investment, where it's rental income coming from that. Maybe it's a business partnership in a business investment that you have. Portfolio income is just that's generated off of stock market investments, brokerage accounts. So this would be your dividends, your interests, capital gains. All of that is considered taxable income. In addition, retirement income is also another category. So this would be income off of Social Security, pensions, retirement accounts, traditional retirement accounts, whether that's IRAs, 401ks, all of that is taxed as income. What's not taxed is inheritance, gifts, bequests, any life insurance that you're the beneficiary of is also not taxed. And Roth IRAs, as an example, which would be a retirement account, is not taxed as ordinary income. HSAs, if you're taking that out to pay for medical costs, that's not taxed as income. 529 plans for education expenses is not considered income. Even distributions out of life insurance, out of the cash value, is not considered income. So depending on what you're doing, whether it's earned, unearned, how it's qualified, depends on what the taxation is. You definitely don't want to get on the wrong side of the IRS. And so to understand the money that you're either earning, have been given, understanding its tax status and your tax liability, and when you need to pay that liability is pretty important. And keep in mind, like on gifts, if you receive a large gift, you won't have to pay tax on that, but that doesn't mean that the individual who is gifting you doesn't have to pay gift tax. So there still might be a tax applied to that amount, but you as the receiver or the beneficiary of that don't necessarily need to pay that tax. Yeah, real estate has become more and more popular as passive income. I think that people are becoming more knowledgeable on they want their money to work for them more than they work for their money. And so real estate is a wonderful investment where we can have that passive income. We make an investment and it's constantly generating income. I think as you get closer to retirement, the importance of creating income portfolios matters. And depending on what that asset is going to directly relate to the taxation of that. And so in many cases here, there's some opportunities where one asset would be taxed more than another asset, depending on how it's characterized.